Welcome to Finance PK. My name is Phil. The goal of this channel is to help you beginning investors, especially those of you that are in high school or college age, getting started working, making some money, and you want to get started investing. You're just not sure how, or if you have the confidence built up to take those first few steps, then this channel is for you. I want to help you build that confidence, get started investing, and be successful. This channel is also for you if you're a little bit older. Maybe you're in your 30s or 40s, like me, and you wish you would have got started younger. And this channel is also for you to help you build that confidence and get started. It's really never too late to get started. Even if you're in your 50s, 60s, 70s, even older, it's never too late to get started. And so I want to jump into it. In the previous video, I talked about a Roth IRA, the importance of starting that, preferably younger. And I want to go into a little bit more depth on the why and the power of compounding, and then some specific investment options and some recommendations that I would advise you to consider getting started being successful with your Roth IRA. So once you've started that Roth IRA, I talked about automating your investment. So of course you can max out right now in the year 2025, you can max out at $7,000 per year if you're under the age of 50. And again, one big advantage of the Roth IRA is that you're never going to pay tax on that money, on the gains or on the withdrawals from that. It's post-tax money. So you've already paid taxes on it, but you can contribute up to $7,000 if you're under 50. If you're over 50, it's $8,000. So that's about $580 a month or so. If you're under 50, about $660 a month if you're over 50 years of age. And that money goes in, it grows tax-free, it compounds. And that's the beauty. And a lot of people say the eighth wonder of the world is compound interest. So you just kind of sit back and relax, kind of make money in your sleep, so to speak, because it's compounding. It's making those gains. So the examples that I gave were that money will double every 5 to 7 years if it's making between 10 and 15%. Remember the rule of 72. But if you start at the age of 18 and you contribute just the minimum, $580 a month, that will turn into $1 million over about 28 to 30 years. Okay, so there's the beauty of that Roth IRA. Now, specifically, as far as investments go, you can fund a Roth with really anything you want. You could buy gold, precious metals. You could buy crypto. I recommend specific index funds or stocks, and what are commonly referred to as low-cost index funds. And I'll go into more depth on specific names of those and companies in another video. But I just want to give you a few names right now and just examples of making that 10 to 15% gain per month, per year. If you can do that, then your money is just going to double. It's going to compound over time. So some specific names then that you can make that at least 10 to 20%. So over the last 80 years, the S&P 500 has made about 10% per year, right? And there's a lot of those funds, and one of those funds is called VOO. There's another fund called the Total Market Index Fund. That's called VTI. That fund has not quite been in existence as long, so it doesn't have that much of that long of a track record as the S&P 500. But some of these funds that you can purchase with Vanguard have made much more than 10 or 15%. But those two have made right about 10 to 12% for the last 80 years. Now, there's a couple companies that I'm sure you've heard of: Apple, Costco, Berkshire Hathaway. Those companies have made upwards of 15 to 20, even 30%. Couple technology funds that you may have heard of. One is called QQQ with Invesco. One is called VGT. Those have made more like 20 or 30%, but not quite for that long of track records. They don't quite have that history of the S&P 500. There's a number of investment options that you could invest that once you automate your Roth IRA amount, the monthly amount, set that up, and then you just sit back, let compounding do its work, let that earn that interest. Of course, it's tax-free, and then when you take that out, it's tax-free. And I'll go into more depth on the next video. We'll see you next time.